Yes, we are live.
Excellent. Thank you. So good afternoon, folks, and welcome to our webinar on both the latest quarter's results for Marcellus's investee companies, and also on the macro situation, right? The macro situation is looking decidedly interesting with the potential for war in one part of the world, and I'll also talk about interest rate hikes. So we thought it'll be a good juncture for both for us to give you a perspective on how the portfolio companies are shaping up on their fundamentals. Generally, we're actually very pleased with how they are shaping up basis not just the recent quarter's results, but also the full year's results. But before we get on to the specifics of the portfolio companies, I'll start off with a perspective on the macro position, and then we'll go to the fund managers, the portfolio managers one by one, starting with Rakshit. We'll go to the portfolio managers one by one for them to share their thoughts on the investment outlook and the results of this quarter. So let me start with the question that we get asked very often over the last 6 months, right? And there's this widespread notion that interest rate hikes are somehow bad for the stock market, right? Now one can have lots of notions, but obviously in the real world, if your notions, your beliefs are grounded in reality, you're more likely to succeed. But if your beliefs are grounded in complete fantasy, it's obviously going to be a challenge. And I think this rate hikes leading to stock market corrections is one such belief. It's grounded in zero data and plenty of fantasy. So let's start with the first point of view. So let's start with US recessions and India's economy. We pointed this out 22nd March 2020. So 2 years ago, when the world was in full panic. The world was in full panic courtesy COVID. We pointed out, and using exactly this visual, we simply extended it, updated it. Using this visual on 22nd March 2020, we said that you can see the data, you can see in the red chevrons. Whenever the United States has a recession, the gray bars, the Indian economy soon follows with an economic boom. The green bars, right? So the gray bars are US recessions. The green areas are Indian economic booms. The red is the indicator which is indicating the difference between the US recession ending and the Indian economic boom beginning. We further showed using the orange line and the blue line that this has happened due to two factors, because the crude oil price, the orange line, crude oil drops by 50 to 80% when America goes into recession. And secondly, the US 10-year bond yield, the blue line, drops by 2 to 2.5% when the American economy goes into recession. Nothing mysterious here. The US bond yield drops by 2 to 2.5%. The global oil price drops by 50 to 80%. And hey, presto, surprise, surprise, you give India cheap oil and cheap money, we have an economic boom. This has happened 4 times in the last 40 years, basically in all of our lifetimes. This has happened 4 times, and thus a US recession is a necessary and sufficient condition for an Indian economic recovery. We never get a boom without a recession in America, and if there's a recession in America, we unfailingly have an economic boom. All of this we pointed out a couple of years ago, right? And we just simply updated that chart. Now there is no change in this picture, right? As predicted by us, and we shouted. I remember doing a webinar on 15th March. It wasn't a webinar; it was one of those. In those days, we used to do it on a phone call. 1,000 of you joined in from a phone call. Rakshit and I joined in from our lockdown-stricken homes. And as usual, I had the worst line, I think, in the universe. I was shouting on the phone saying there'll be an economic boom in India. There was no Zoom in that era. Feels strange now. Without Zoom, I was shouting into a phone line, there's going to be an economic boom. We were writing newsletters, and we were all sitting at home trying to cheer ourselves up as the Prime Minister told us that you have to sit at home for the next couple of weeks. Now, 2 years on, this has broadly worked out. What happens now? Rising interest rates are bad for the stock market. No, not really. The data doesn't show that. So why doesn't the data show that rising interest rates are bad for the stock market? So let's start with a little bit of common sense, and we'll come on to the data. Typically, central bankers hike rates when the economy is overheated. When the economy is absolutely going gangbusters, central bankers hike rates to take some of the steam out of the economy, right? Why do they do that? Why do they take some of the steam out of the economy? Because if you take some of the steam out of the economy, you elongate, you extend the economic recovery. Right? This is not some sort of punishment that the central banker is exerting. The central banker hikes rates gradually as the economic recovery proceeds to elongate the economic recovery. And therefore, for two very good reasons, rising interest rates are good for the stock market. A, it's a signal that the economy is in great shape. And B, it's a signal from the central banker saying, I want to elongate this recovery. I want to extend the recovery, right? And therefore, both in America and in India, 70 years of data shows that rising interest rates tend to be accompanied by rising stock markets, right? In fact, the S&P 500 typically compounds at 9% per annum when rates are being hiked. There's been 12 rate hike cycles since the Second World War. In 11 out of 12 of these, the US stock market has been on a bull run. If you look at the last two bouts of big rate hikes, which happened in this century in America, 2004 to 6, the Fed hiked, I think, 9 times. 2004 to 6, the Fed hiked 9 times. The S&P 500 went up by 50% in those 2 years. The Indian stock market nearly doubled in those 2 years. More recently, 2015 to 2019, I think the Fed hiked by 2.25%, something like 15 rate hikes, cumulatively 2.25% rate hike between 2015 and 2019. In just the first 2 years of that rate hike cycle, the S&P 500 went up 50%, right? So anybody out there who tells you कि boss US interest rates बढ़ता है, S&P 500 नीचे जाता है, please ask them to check the data because the data doesn't agree with that. Now, let's come to India. And what happens in India? Surprise, surprise, no different. We are also a free market economy. In India, in this century, there have been 4 instances of sustained rate hikes, right? Multiple rate hikes, 4 बार हुआ है in this century. In every single one of those periods, the Nifty has generated healthy returns. How much? What are the returns like? Here we go. Here's the data, right? You had 29% compounded, 03 to 08. I'm sure many of you remember that boom. 2009 to 12, right? In Indian economic history, that was seen as a muted boom because only 17% compounded, right? In that period, I think then RBI governor did, I think, 16 rate hikes between 9 to 12, 17% compounded. 2013-14, this is the cycle which overlapped with BJP coming to power. And then the last one, 2017 to 18. Remember, I said the Fed was hiking, we were hiking as well. Decent stock market. So, notion that rising in interest rates leads to a bear market, unfortunately, doesn't stand up to scrutiny. Rising interest rates usually happen in an economic recovery and lead to stock markets rising as well. Now let's come to the next notion that is paraded, that is put out in front of investors. The notion is that somehow, again, based on where people find these notions, I find very interesting. But let me first give you the notion. The notion is, the myth is, high inflation is bad for high quality stocks, right? Now, you'll have to be a little challenged on common sense to make this point of view that high inflation is bad for high quality stocks, because as we just discussed, an economy picks up steam. When an economy picks up steam, inflationary pressures build up. That's what we discussed in the preceding slides. In such circumstances, when inflationary pressures pick up, every shred of data shows that high quality companies of the sort that we will discuss over the next 45 minutes, as inflationary pressures pick up, high quality companies become even more dominant in growing their PBT margins, growing their revenues, and growing their share prices, right? Let's quantify. So what we did was, we looked at every single month in this century, starting with July 2000, ending with July 2021.